footprint in light of U.S. President Donald Trump's executive order to impose 25% tariffs on most vehicle and auto part imports to the U.S. The duties have upended international trade and forced automakers to overhaul production plans. And in Nissan's case, even business restructuring plans. Nissan said it has built up good inventory of U.S.-built product ahead of the tariffs. Currently, more than half of our U.S. sales volume is sourced from our plants in Tennessee and Mississippi, Nissan said in a statement. The company currently has ample inventory at our U.S. retailers that is unaffected by the new tariffs. We will continue to evaluate the impact, as well as market needs, to make any additional adjustments to production. The Smyrna announcement is one of several tariff-triggered reshuffles coming from Nissan. In Mexico, for example, the company's Infiniti premium brand will stop output of the QX50 and QX55 crossovers bound for U.S. dealerships because of the duties. Those vehicles are made alongside the Mercedes-Benz GLB at the company's Compass joint venture factory in Mexico. Meanwhile, Nissan said April 4 it has consolidated production of its Frontier and Navara pickups for Latin America at its Cuernavaca factory in Mexico. The Japanese carmaker said it would continue output of other U.S.-bound models in Japan and Mexico based on market needs. Frontier production for the U.S. market will stay in Canton, a Nissan spokesperson confirmed. Supply of the Rogue is especially critical to Nissan. Its U.S. sales declined 9.5% to 245,724 in 2024. But nearly 93,000 of those were imported from Japan. Now, with Japan shipments facing a duty, dialing up U.S.-sourced Rogues makes sense. Last year, the Rogue was the No. 9 best-selling nameplate among all brands in the U.S. Title: Tesla sales lag again in key European markets in March amid Musk protests. Content: After Tesla's sales dipped sharply in Europe in January and February, a key question was whether the decline would continue in March, traditionally a strong month for the U.S. electric vehicle maker, which focused on quarterly deliveries. Now, March sales figures from Europe's biggest markets suggest that Tesla's sales drop may be structural rather than cyclical and reflect consumer sentiment toward CEO Elon Musk, who is now a close advisor to President Donald Trump on cutting government spending and has sided with right-wing and far-right parties across Europe. Sales fell in many major Western European markets, see chart below. Even when Tesla's sales increased, they trailed the larger EV market, which has returned to growth this year as new EU emissions targets come into effect. Tesla's global quarterly deliveries fell by 13%, despite Musk pledging that Tesla would return to growth. Anger against Musk has boiled over in recent months, with protests at Tesla dealerships that included cars being set on fire and vandalism against Teslas parked on the street. Tesla is also suffering from a lack of new models to complement the aging Model 3 and Model Y, and it is changing over to a major refresh of the Model Y, which is built in Germany. At the same time, it is facing more competition from European and Chinese automakers, which can match Tesla on price and technology. The UK has become Tesla's biggest market in Europe, and sales were up 20% in March and 6% in the first quarter. But overall UK EV sales were up 43% in March, and 43% for the quarter. New rules taking effect in April that could increase ownership of expensive EVs may have contributed to that surge, the SMMT lobbying group said. In France, Tesla's No. 2 market in Europe, sales fell 37% in March and 41% for the quarter. In Germany, where Tesla has its sole European factory, which builds the Model Y midsize SUV, sales fell 43% in March and 62% for the quarter. Musk has been criticized for his support of the far-right Alternative for Germany party there. Italy bucked the trend, at least in March. Sales grew 51% in March to 2,217, just 12 behind Germany. However, Tesla failed to keep pace with the EV market, which was up 75% for the month. Tesla sales also rose in Spain, up 34% for the month but down 12% for the quarter, despite overall EV sales nearly doubling in March compared with March 2023, and quarterly EV registrations rising by 69%, from a low base. Spain has some of Europe's most generous EV subsidies, and the program was extended to 2025. Tesla also struggled in other European markets, with sales down in Norway, -1%, the Netherlands, -55%, Sweden, -64%, and Belgium, -69%. Analysts said this week that they expect Tesla's sales to continue to fall. This is our first look at the impact of recent brand damage, and it appears to be the primary driver behind this quarter's delivery decline, Gene Munster, managing partner at Deepwater Asset Management, said on X. These growth rates will likely deteriorate further this quarter. Munster estimates 2025 deliveries will be 9% below the 1.79 million Tesla reported last year. Deutsche Bank analysts expect a 5% drop this year, assuming a staggered rollout of Tesla's anticipated cheaper car. Tesla is expected to prioritize delivery volumes at the cost of margins again this year with more incentives and lucrative financial deals, they said. Tesla has not announced when a cheaper model will be launched and at what price. Tesla's stock has fallen 45% from a mid-December peak. Musk has said Trump's 25% tariffs on cars and parts imported into the US will mean more costs, because Tesla imports substantial quantities of materials used to make batteries. Morningstar analysts said tariffs on such parts could add about 5 to 10% to Tesla's vehicle cost. There are signs that Musk may be on his way out at the White House, where he runs the Department of Government Efficiency, or DOGE, which is cutting billions from the federal budget, including laying off tens of thousands of federal employees. Recent news reports have suggested Musk could soon leave Trump's side, although it was not clear if Musk would leave before his 130-day mandate as a special government employee expires around late May. Trump said on April 3 that Musk can stay as long as he likes. He's going to stay a certain period of time and then he's going to get back to his businesses full-time. But he's doing a fantastic job, Trump said. Reuters contributed to this report. Title: Will Carvana be ready for the next market shift with tariffs? Confidence is there. Content: A changed used vehicle market tested Carvana in 2022. 3 years later, the company is primed to meet used vehicle supply and demand shifts, including those arising from tariffs, analysts say. President Donald Trump's 25% tariffs on imported new vehicles took effect April 3, and tariffs on vehicle parts are to follow May 3. Used vehicle sellers are trying to assess the degree to which trickle-down increases on new vehicle prices will drive U.S. consumers to buy used instead. Read more, live updates on tariff news and impacts. Interactive map, auto manufacturing sites in Canada, the U.S., and Mexico. A substantial increase in new vehicle prices would hamper affordability and trigger consumers to shop secondhand, analysts at investment bank Morgan Stanley said in a research note published March 27. It could present an opportunity for players such as Carvana and CarMax Incorporated, they said. Our business has never been stronger operationally or financially, he wrote. We feel very confident in our ability to operate in and adapt to the macro landscape as it evolves. Carvana overestimated sales growth in 2022 on expectations that strong e-commerce buying activity observed in 2021, amid COVID-19, would carry over. But inflation and interest rate increases dampened consumers' willingness to make large purchases, used vehicles included. That shift caused trouble for Carvana and smaller auto e-commerce peers. Investor sentiment also changed. Wall Street liked Carvana's track record of sales growth, especially since its public offering in 2017, but that was not enough. Investors saw evidence of profitability and control of cash burn. Carvana has streamlined operations after more than 2 years of intense focus on efficiency, Jenkins wrote. That included cost-cutting, restructuring debt and insourcing more vehicle inspection and reconditioning, among other measures. We're in a much stronger position than we were 3 to 4 years ago, Jenkins wrote. The amount of debt previously on Carvana's balance sheet also gave analysts pause, Morgan Stanley's Adam Jonas wrote in a research note March 25. But the company is making enough money after expenses now to support self-financing, Jonas wrote. That gives Carvana a better opportunity to pay down its $5.6 billion debt balance over time. Shares of Carvana closed at $226.32 on April 2, up 173% from a close of $82.87 the same day in 2024, but fell 20% to close at $181.79 on April 3 amid broader tariffs uncertainty. Broadly, used vehicle sales could see an initial boost after tariffs implementation, assuming automakers pass added costs on to the consumer, said Sharon Zakfia, an analyst covering CarMax and Carvana for William Blair. If vehicle affordability takes a big hit, and there are a lot of ifs here, then I would expect that to cause some slowdown in overall used car sales, she said. Zakfia said she gives Carvana credit for its agility in different market scenarios during the last 5 years. Both it and CarMax, she said, have an advantage, national brand recognition. Chris Pierce, a research analyst covering Carvana and CarMax for Needham & Company, sees supply and credit holding back used vehicle purchases. In the near term, after an initial, short surge in buying, Cox Automotive expects vehicle sales to fall, new and used prices to increase, and some models to be eliminated if tariffs persist, Cox chief economist Jonathan Smoke said in a tariffs commentary March 28. More insight on how tariffs could drive demand for used vehicles will be available next month. CarMax is due to report results for its fourth quarter, December-February, on April 10. In 2024, Carvana released its first quarter results in May. Title: Trump's tariffs challenge Korea and other industry friends. Content: Seoul, Hyundai and its Genesis brand are determined to find their way in the new trade landscape, but the path is tricky if not treacherous. In the immediate wake of President Donald Trump's announcement of sweeping auto tariffs, Hyundai Motor CEO Jose Munoz said the company would not hike prices as a knee-jerk reaction. We have seen the tariff announcement, and we are evaluating the impact, Munoz said from the stage at the Seoul Mobility Show on April 3. Hyundai has a long history of creating value for customers. We will always remain competitive, and there are no plans to raise prices in the United States at this time. Read more, live updates on tariff news and impacts. Interactive map, auto manufacturing sites in Canada, the US, and Mexico. Analysts say taxes of 25% on imported vehicles, to be followed next month by tariffs on auto parts, will reduce supply, raise prices, and decimate industry profits. While Hyundai Motor Company, which includes the Genesis luxury brand, and sibling Kia Motors Corp., recently opened a large, shared assembly complex in southern Georgia, the brands still rely on South Korea for the majority of the vehicles they sell in the US, leaving the group especially vulnerable. Hyundai Motor stock fell 14% over the 4 trading days leading up to the official tariff announcement and 1.3% the day of Trump's speech, which landed early in the morning here. Trump, who hosted Hyundai Motor Group Executive Chair Yuuzhan Chung last month at the White House for an announcement of $21 billion in new U.S. investments, said trade imbalances have put the U.S. in peril. He called out South Korea among allies that have non-monetary restrictions that he said let them take advantage of the U.S. In many cases, the friend is worse than the foe in terms of trade, Trump said after U.S. markets closed April 2nd, which was just hours before the Seoul Auto Show started. But such horrendous imbalances have devastated our industrial base and put our national security at risk. Once protected by a free trade agreement with the U.S., Hyundai's massive operations in the Republic of Korea are facing a huge uphill run against such large taxes on automotive imports. Korean markets and major industrial companies that do business in the U.S. are sorting through foreboding economic challenges. First, there are the tariffs, which make exports from Korea less competitive. Paired with concerns that Trump's policies are leading the U.S. economy into stagflation, stalled growth and rising prices that will deflate demand. The combination indicates that major players here from LG Energy Solution to Samsung are getting less access to an increasingly less attractive market. For a company such as Hyundai Motor Group, which counts the U.S. as its largest market, it's a nasty 1-2 punch. And a third one is likely to follow. Kim Hung-ik, adjunct professor at the Sogang University Graduate School of Economics, wrote in the April 1st edition of Korea Jingong Daily, an attack on South Korea's currency. In Trump's first term, he focused his tariff policies on China, increasing the tax almost sevenfold to 21%, while leaving tariffs on allies largely unchanged, Kim wrote, citing the Peterson Institute for International Economics. And yet the U.S. trade deficit with China grew, in part because Xi's government devalued the renminbi by 14% to help exporters compete. So just as Trump is broadening his import taxes to longtime allies, he's likely to pursue currency actions against them as well. Stephen Miron, chair of the Council of Economic Advisors, argues that the U.S. dollar is overvalued and that remedying that imbalance would minimize tariff-induced inflation. Kim suspects that Trump will target currencies of countries with the largest trade surpluses with the U.S., such as China, Mexico, Japan, and South Korea. The new tariff policy is particularly challenging for a brand such as Genesis, which imports more than 2/3 of the vehicles it sells in the U.S. Hyundai's luxury brand, a rarity in Korea, has been growing in the U.S. Sales last year rose 8.4%, far outpacing the industry's 2.5% expansion. Much of the inspiration for the standalone Genesis stores comes from the brand's flagship retail outlet here, Genesis Suji. With a corrugated steel exterior and concrete walls that resemble wood grain, it is an elite showroom where associates, called curators, help Sunnim honored guests select the exact vehicle they want. It takes about a month from order to delivery. The process concludes with a very Korean ritual. The buyer arrives and is welcomed into a luxurious waiting room with comfortable magma orange chairs and their name on a giant screen. Looking through 2 glass walls with sliding doors, they see their car covered in a sheet, then dramatically unveiled. Robot arms act like they are inspecting it as they would in quality control coming out of a paint shop. It's all an act. The video screens are playing a pre-recorded inspection, not what the robotic cameras would be seeing. The customer knows, but the point is to convey the care paid to each vehicle. Eventually, the car is pulled forward to the middle room, seemingly by itself, and rotated on a turntable to be driven away after features are explained to the new owner. It's such an elaborate process that the Suji can host only 4 such deliveries per day. U.S. stores are not equipped for all of that, but every standalone Genesis store has an indoor delivery space, which makes for a more comfortable experience during, say, a New York winter or Florida summer. While Hyundai's plant in Montgomery, Alabama, made 23,000 Genesis GV70S last year, equivalent to about 40% of the brand's crossovers sold in the U.S., all 18,000 Genesis sedans sold in the U.S. were imported from South Korea, according to Auto Forecast Solutions. That means most of the brand is now facing the costly tariffs. There is also risk for those GV70S made in Alabama. Consumers are often not well informed on where their vehicle is produced, Stephanie Brinley, an analyst with S&P Global Mobility, said in an email. Brands known to be based outside of the U.S. may see consideration fall for non-tariff vehicles as well, if consumers assume production is outside of the U.S. Every Genesis nameplate is made at Hyundai's massive Ulsan manufacturing complex in southeastern Korea, which has its own in-house port to the East Sea, which is also known as the Sea of Japan. Autos designated for export are driven from the factory onto ships, such as the Morning Christina, on the day of my visit, or one owned by Hyundai Glovis, one of many Hyundai Group companies that dominate the industrial city. The Morning Christina's captain said on April 2nd that the ship, still mostly empty, was destined for California, a 13-day trip. By the time he and his crew of 21 get there, their cargo of 5,000 or so vehicles will face the 25% tariffs. Under the 2007 free trade agreement between the U.S. and South Korea, there had been no tariff. The Ulsan complex is considered the world's largest manufacturing site. Its 5 assembly plants produced 1.5 million autos last year, equating to a highly efficient 98% of its straight-time capacity. It also has stamping, welding, and painting facilities as well as engine and transmission plants. 2 of the assembly plants produced 192,000 Genesis vehicles last year, 89% of the brand's global output, according to Auto Forecast Solutions. Automakers had a pretty good idea that the tariffs were coming, but most were reluctant to react too quickly. Munoz's comment about not immediately raising prices was newsworthy after Reuters reported that Randy Parker, CEO of Hyundai and Genesis Motor North America, told dealers in a note that current vehicle pricing is not guaranteed and may be subject to change for units wholesaled after April 2nd. Like Munoz, Kia CEO Ho Sung-song resisted jumping to a decision. Hans Greimel contributed to this report. Title: Ford recalls more than 105,000 expeditions, Lincoln navigators over faulty seatbelts. Content: Ford Motor Company. is recalling 105,322 SUVs over seatbelts that may fail to retract or extend, according to a March 28 report from NHTSA. The recall covers 2018 to 20 Lincoln Navigators and Ford Expeditions. NHTSA opened the investigation into the SUV's seatbelts last year. Ford is not aware of any accidents or injuries related to the defect, according to the report. On affected vehicles, the driver or front passenger seatbelt retractor pretensioners may deploy inadvertently, the report said. The seatbelt will then be locked in position, unable to retract or extend, increasing the likelihood of injury in a crash. The defect is because of oxidation in a portion of the seatbelt pretensioner. ZF is the manufacturer, according to the report. Those impacted can take their vehicle to a Ford or Lincoln dealer to have the pretensioners replaced. Ford has a reimbursement plan for those who have already paid for the issue to be remedied. Dealers were notified of the recall on March 31st. Owners will be notified from April 14th to 18th. Title: Dealership can defend itself against lawsuit stemming from test drive crash, court rules. Content: How long and how far is too long and far for a test drive? That's a question for a jury in the Queensborough of New York City to decide in a personal injury lawsuit against a dealership after a customer's negligence caused a freeway crash, an appeals panel ruled. The decision means Paragon Motors of Woodside, which has Honda and Acura franchises, can defend itself against a claim that it's responsible for Natalie Madrigal's injuries because it owned the vehicle that rear-ended her Mercedes-Benz. The customer, Baldavbhai Patel, testified in a deposition that a salesperson gave him the keys to the used 2018 Acura RDX and told him to go ahead and do your thing for a 2021 test drive. He drove on local streets near the store before hitting the freeway, according to the decision from the Appellate Division of the State Supreme Court. However, the salesperson testified he told Patel to drive around the block one time and return within 5 or 10 minutes. He also said he didn't give Patel permission to take the Acura on the freeway. The salesperson said he phoned Patel about 20 minutes after the test drive started but got no answer. Patel returned the call about 35 minutes afterward to report the crash, the unanimous March 19 decision said. A lower court judge found both Patel and Paragon Motors liable. The appellate court upheld Patel's liability but said the dealership can pursue its argument that it hadn't authorized him to drive the car where and when the crash occurred. The court ruled there were triable issues of fact, a factual dispute substantial enough to warrant a trial, as to whether Patel was driving in a place and for a time period that exceeded the terms of the consent given, the decision said. Title: Don Romano's Wild Ride at Hyundai Canada. Content: A wild ride. That's how Don Romano describes his 10-year term as CEO of Hyundai Auto Canada. We took a number of big risks, said Romano, who on March 10 assumed roles as CEO of Hyundai Motor Company Australia and Chief Advisor to the Hyundai Motor Asia Pacific. Among his key accomplishments, having Hyundai's 226 Canadian dealers invest more than $1 billion into their facilities, launching the luxury Genesis brand and pioneering the direct-to-consumer agency model and the sponsorship deal with the National Hockey League, Romano said. Romano was born and raised in California and is a 40-year veteran of the sector. During his time in Canada, which began in early 2014, he has emerged as a vocal advocate for diversity, equity and inclusion (DEI) in the auto industry as well as philanthropic causes, including combating homelessness and fighting pediatric cancer. Romano's successor is Steve Flamond, who was previously the Executive Director of National Sales and Digital Strategy. His advice. Title: Don Romano's Wild Ride at Hyundai Canada. Content: A wild ride. That's how Don Romano describes his 10-year term as CEO of Hyundai Auto Canada. We took a number of big risks, said Romano, who on March 10 assumed roles as CEO of Hyundai Motor Company Australia and Chief Advisor to the Hyundai Motor Asia Pacific. Among his key accomplishments, having Hyundai's 226 Canadian dealers invest more than $1 billion into their facilities, launching the luxury Genesis brand and pioneering the direct-to-consumer agency model and the sponsorship deal with the National Hockey League, Romano said. Romano was born and raised in California and is a 40-year veteran of the sector. During his time in Canada, which began in early 2014, he has emerged as a vocal advocate for diversity, equity and inclusion (DEI) in the auto industry as well as philanthropic causes, including combating homelessness and fighting pediatric cancer. Romano's successor is Steve Flamond, who was previously the Executive Director of National Sales and Digital Strategy. His advice to Flamond: don't try to be me. Be you. Flamond, Romano added, has been with him through the most difficult times and has helped me grow the business. All the decisions that we made together. Romano discussed a wide range of issues confronting the industry. The interview has been edited for clarity and length. Question: What are you most proud of? Answer: I would say Genesis because it was launched globally, but Canada has been the most successful country outside of Korea. We launched a brand from scratch and gave the agency model a chance. To see it succeed really meant a lot to me, to my dealers. Question: What was the biggest challenge? A. COVID-19 was by far the biggest, and there was another risk we had to take. As soon as we went into lockdown, I got all the dealers on the phone and said, "You will stay open," and a lot of them said, "Absolutely not." I said we're going to put together safe and sound packages, with PPE and other supplies, which we sent to every dealer. We trained our district managers on how to deploy the packages and make sure we were abiding by the proper protocols. That gave us an advantage over brands that went into hiding. And it gave us a chance to accelerate. Our market share reached a record level. So, we were able to take care of our customers during a very difficult time, but we also sold a lot of cars and at a time where some of our competitors had shut down. That gave us some momentum going and it hasn't stopped. Question: Hyundai posted record sales in 2024 and is the second largest import company in Canada over the last 3 years. How does that make you feel? A. What makes me feel good is the brand has never been stronger. What those numbers don't say is that we were the second lowest fleet brand in the industry in Canada. We pulled the fleet way back, and we watched dealer profitability grow. I pushed them to invest over $1 billion into the facilities, and then I lost sleep for about a year wondering, are we really going to be able to pay for that? Those returns and record levels bring a smile to my face. Question: What are the differences between the Canadian and US markets, and how did you keep dealers and consumers happy for so many years? A. In Canada, we still have family-owned dealerships, while in the States you have big corporations, like the auto nations. They're the dominant players. Canada does have larger groups, but you can still meet with senior executives, have dinner with them and talk about strategy. You still have the personal contact and I think makes the difference. Question: With governments ending or scaling back EV rebates, will adoption decelerate? A. It's going to slow down. We're already seeing it. But, we're still seeing demand because they're fast and they're fun to drive. It's important that we continue to stay true to our vision, true to our belief stream, because, ultimately, technology will continue to improve, and pretty soon we're going to have a 5-minute charge that's going to take us over 1,000 kilometers. And that's going to be great. Question: How do you feel about where the industry is on day? A. Aside from the altruistic point of view, I believe you have to stand up for what you believe in. Spend a day in your showrooms and look at who walks in and tell me if they look like a bunch of old white guys like me. They look like the United Nations in Canada, and the same in Australia. It makes logical sense that your organization reflects the same composition that your customers represent. Most car buying decisions are made by females. Yet, we are terribly lacking in terms of female representation in our executive ranks. Question: Do you think the arrival of China-made electric vehicles is inevitable? A. The federal government has held them at bay with tariffs, giving the industry between 5 and 10 years. After that, we won't be able to hold them back. All brands that are interested in North America are going to find a way to build here and sell here. In doing so, we're going to see a different cost structure that's going to be more competitive with the current landscape. Question: How do you see the US trade war with Canada playing out? A. It's almost impossible to gauge the US and what they're going to do next. Ultimately, we need to be of one mind working together to get the maximum efficiencies and not through artificial tariffs that are doing nothing but increase cost and making our products less efficient. I think, ultimately, logic is going to prevail and it's going to say, hey, we're better as one North American organization working together in our numerous industries to provide maximum efficiencies. And if we don't, there's a lot of companies overseas that will do it for us, and that doesn't make sense to me. I'd say it's a temporary situation. It's a negotiating tool. It's a ploy right now, but eventually this, too, shall pass.